In our current market, I'm getting asked quite a bit how the Fed fund rate increases are affecting mortgage interest rates. So let's take a look, shall we? The federal funds rate is the interest rate that banks charge each other to borrow money for overnight loans. On the surface, it doesn't appear that the federal funds rate has much to do with mortgage interest rates or our daily lives, except that it affects the cost of everything we do not pay cash for. For example, if you finance a new car, the bank has to consider their borrowing cost into what interest rate they offer you on your car loan. The current Fed funds rate is 3 3/4 to 4%. That means if the bank has to borrow money, it will cost them between 3 3/4 to 4% depending on the day. The purpose for the bank charging you interest is so they can make money on your car loan. So if the bank wants to make money, they have to charge you more than the federal funds rate in order to cover their cost of borrowing and any overhead costs to maintain and service your car loan. Same thing with your credit card. If the federal funds rate goes up and it costs the bank you hold your credit card with more to borrow money, then your credit card interest rate will go up and you will pay more for any balances on your credit card that are not paid off in full each month. Mortgage rates are influenced by a large variety of things and fluctuate daily, sometimes even several times in one day. Yes, the federal fund rate is a factor, but not the only one, and really not the most important one. Things like unemployment, inflation, oil costs, the stock market, global importing and exporting of goods and services, and even the political environment all affect the mortgage interest rate being offered that day. The federal funds rate has an indirect effect on mortgage interest rates, but has a very direct effect on shorter term loans like car loans or revolving debts like credit card balances. Want to know more? Have more questions? DM me.